Every morning before the market opens, dozens of stocks are already moving, some up 5%, 10%, even 20% or more from yesterday's close. Most traders see that and think, I missed it. But experienced day traders see something different. They see a setup. It's called gap and go. And when the conditions are right, these pre-market moves are just the beginning. Let's get into it. A gap happens when a stock opens at a significantly different price from where it closed the day before. If it opens higher, that's a gap up. If it opens lower, that's a gap down. Gaps happen because of overnight activity, earnings announcements, news events, analyst upgrades or downgrades, sector-wide moves, or unusual pre-market trading volume. Something has changed between the close and the open, and the market is repricing the stock. The gap and go strategy focuses on trading in the direction of the gap. The core thesis is this: if a stock gaps up for a legitimate reason and the setup confirms, there's likely more upside to come as the broader market reacts throughout the session. You're not trying to fade the gap, you're riding its momentum. Here's the psychology behind it. When a stock gaps up significantly, short sellers who are holding overnight are immediately underwater. As the stock keeps moving, they're forced to cover their positions, which means buying shares. That buying adds fuel to the move. It's called a short squeeze, and it often accelerates a gap. At the same time, momentum traders who scan for gapping stocks pile in, adding more buying pressure. Algorithms pick up the volume surge and jump on board. The result, a stock that gapped up 5% before the open can run another 5, 10% or more in the first hour of trading. This doesn't happen every time, but when the right conditions line up, the move can be powerful. Finding gap stocks is easy. Every trading platform has a pre-market scanner. You're looking for stocks that are gapping up at least 3 to 5% with significantly higher than average pre-market volume. But not every gap is a gap and go candidate. You need to filter. First, there should be a catalyst. Earnings beats, FDA approvals, contract announcements, major partnerships, something fundamental that justifies the gap. Gaps without a catalyst are more likely to fade. Second, look at the float. Low float stocks, those with fewer shares available for trading, tend to produce bigger moves because it takes less buying pressure to push the price. This is a double-edged sword, though. Low float means higher volatility in both directions. Third, check the pre-market price action. Ideally, the stock should be consolidating near its pre-market highs. If it gapped up and then sold off 50% of the gap before the open, that's a weaker setup. You want the gap to be holding. Fourth, relative volume should be high. Look for at least 2 to 3 times the stock's average volume in pre-market. This confirms that real interest is behind the move. Here's the execution framework. The opening bell rings. Watch the first few minutes. Does the stock hold above the pre-market high? Does it break above it with volume? If yes, that's your entry trigger. Entry: buy the break above the pre-market high or above the first 5-minute candle high with a clear volume confirmation. Stop loss: place it below the low of the first 5-minute candle or below a key pre-market support level. Define this before you enter. Target: use a risk-to-reward ratio of at least 2 to 1. If your stop is 50 cents below your entry, your first target should be at least $1 above. You can also use prior resistance levels, round numbers, or VWAP deviation bands as targets. Scaling out is a smart approach here. Take partial profits at your first target, then let the rest ride with a trailing stop. Momentum stocks can move fast, and you don't want to leave the whole move on the table if the trend continues. Not every gap is worth chasing. Here's when to sit on your hands. If the stock has already run 20% or more in pre-market, the easy money may already be gone. The risk of buying at the top increases dramatically. If there's no catalyst, be very cautious. Unexplained gaps often fade within the first hour. If the broader market is weak, SPY gapping down, risk-off sentiment, long gap, and go setups have a headwind. Context matters. If the bid-ask spread is extremely wide in pre-market, that's a sign of low liquidity and high risk. You can get filled at a terrible price on the way in and an even worse one on the way out. And if you're not at your desk at the open, skip it. This is not a strategy you set up and walk away from. It requires attention, execution speed, and active management. Here's a typical gap and go morning. Before the open, you pull up your scanner. 2 stocks stand out. One gapped up 8% on strong earnings, the other up 12% on an FDA announcement. Both have high pre-market volume and are holding near their pre-market highs. The bell rings. The first stock immediately pushes above its pre-market high on heavy volume. You enter long. Your stop is below the opening 5-minute candle low. The stock runs another 6% in 20 minutes. You take half off at your first target and trail the rest. The second stock opens and immediately sells off. You don't chase it. No confirmation, no trade. You save your capital for a better setup. That discipline, taking what's there and ignoring what isn't, is what separates consistent traders from gamblers. Gap and go is about riding the momentum of stocks that gap up on a catalyst confirmed by volume and pre-market price structure. Scan for gaps of at least 3 to 5%. Filter for a catalyst, high relative volume, and a pre-market chart that's holding its gains. Enter on the break above pre-market highs or the first candle high. Manage with a stop, a target, and a trailing exit. It's fast. It's exciting, but it only works when you're disciplined about which gaps you trade and how you manage the risk. Subscribe if this series is adding to your toolkit. We're building a full library of strategies here, all grounded in logic, not hype. See you in the next one.